Hello and welcome to the eToro Summer School. I am Sam North, the Trading School Lead at eToro, and it is an absolute pleasure to be your host for these upcoming classes. Our first session today is on why should I invest? A very common question and one we will look to break down and explain for you before we explore further subjects like can you afford to invest? When is a good time to start investing? What type of investor are you? What should be your investment goals? Choosing what to invest in, how to pick a stock, and the psychology of investing and much, much more. First things first, let's discuss the main reason people actually invest. It's to make money. If you are someone who plays sport or plays an instrument, unless you're Cristiano Ronaldo or Beyonce, chances are you aren't doing it to make money and instead you're playing for enjoyment. But that simply just isn't the case with investing. People invest to make returns, to try and beat inflation and to build wealth over time. Here at eToro, we have seen a massive rise in recent years of people looking to invest, and we feel we have a duty to help educate you all, and of course that education must be free. So sit back and relax and let's get stuck in. A survey from 2020 showed that a third of Brits own stocks and shares, which was a 50% increase from 2018, and a report released earlier this year showed that 80% of Gen Z are now investing. However, it is worth noting that this report showed a massive 64% of the 16 to 25-year-olds surveyed have experienced some form of investment loss, which is why here at eToro we want to give you all the opportunity to learn how to navigate the markets and become a better and more knowledgeable investor. So back to the reason why people invest. You could just leave your money in a bank, but the problem with that is that every year you're effectively losing money to inflation. Have you noticed things get more expensive each year? Whether that be the train tickets, gas bills, your food shop, or even the price of a Freddo chocolate bar, well, that's inflation. So another reason people invest is to try and beat inflation. But does investing actually beat it? While past performance is no guarantee of future results, stocks have historically provided higher returns than other asset classes. An analysis of holding periods between 1926 and December 31st, 2017 found the annualized returns of a portfolio comprised exclusively of stocks in the S&P 500 was 10.22% a year, well above the average inflation rate of 2.89% for the same period. It is of course worth noting that you could start investing in a year that the stock market doesn't go up or that inflation is higher than your returns. It is important to have a long-term mindset, and the numbers and statistics do back this up. As mentioned earlier, the most invested stock market in the world, which is the S&P 500, averages around about 10% a year return over the last century and has positive yearly returns over 70% of the time. This doesn't mean you can expect 10% growth every year. You could experience a gain one year and a loss the next. But if you keep your money invested for the long term, the goal is that with these gains and losses, they're going to average out over time, ideally ending in the black by the end of the investment period. Now we have some stats to back up the reason for investing. Let's look at what that could look like for us in the future if we were to start today. Using the average returns of the US stock market, let's say I start by investing $200 or pounds every month for the next 10 years with a 10% rate of return on average. My investment would be now worth $41,851. Now that number is not to be sniffed at, but let's see what happens if we change the time frame from 10 to 30 years. With the power of compounding, that investment would now be worth $459,000. Again, this isn't us saying you'll be guaranteed these returns, but if history is anything to go by, this is what it would look like. The math shows the importance of regularly investing and having a long-term investing mindset, which is something we will focus on later on in class. Let's just focus a little bit more on compounding, because Albert Einstein is rumoured to have said the following: compound interest is the eighth wonder of the world, and compound interest is the most powerful force in the universe. And seeing as we are talking about quotes from famous people, Benjamin Franklin once said, "Money makes money, and the money that makes money makes money." Assume you have £100,000 today, which of course would be lovely, but let's say you invest and get an average annual return of 5%. In a year, that £100,000 would earn £5,000. And if all those portfolio gains are reinvested, you would earn £5,250 in the second year, £5,512 in the third, and £5,788 in the fourth year, and so on. But your investments can only benefit from compound interest when the returns are reinvested. Had you withdrawn all the returns you earned on your £100,000 investment, you would only be earning £5,000 each year. In the short term, the impact of not reinvesting returns may seem insignificant, but wealth building takes time and patience. So if we extrapolate those returns over 30 years, there is a massive difference in wealth between an investor who reinvests their returns and an investor who doesn't. When reinvesting returns, your initial £100,000 investment grows to £432,000, or 4.32 times what you started with over 30 years. On the other hand, your investment would only grow to £250,000, or 2.5 times what you started with, if you withdrew your returns, which means you lose out on almost £182,000 by not reinvesting your returns. Essentially, compound interest is an accelerant for your investments. We've just seen the math that shows with it your wealth grows quicker, which can bring you closer to your financial goals, especially if you start early and leave your investments for long enough. As you can see from those numbers we have just discussed, another reason why people invest is to save for the future, whether that be for an earlier retirement, a house, or even just something for their children. Investing correctly can prove beneficial for them. Now you might say, why don't I just leave my money in the bank? And earlier we said because of inflation. But the other thing to mention is that interest rates are historically low right now. Gone are the days where rates are above 10% and you could get a return on your savings. As we go through the different classes, we will talk about investing ideas in more detail, as well as discussing some extra bonus content like, should I invest during a recession? Our aim here is to give you the knowledge needed to help you on your investing journey, so please do remember that you can ask any questions via our social media channels. In summary, why should you invest? Well, we've discussed that people do so for a number of reasons, but first and foremost, it is about making money. With interest rates low, investing for the long term can prove a beneficial decision when done correctly. Another key reason is to try and stay ahead of and beat inflation. We have gone through the stats and now we know that if we look at the US stock market, for example, its return of roughly 10% is higher than the average inflation number of 2 to 3% a year. Whether you decide to invest for an early retirement or to buy a house or simply just to live more comfortably, there are of course more variables we need to consider to make sure we're successful. Join us next time as we go into more detail. See you soon.